Hey, if you're looking for the good, the bad, and the ugly about Open Door Capital, that investment firm that's bought almost $1 billion of real estate over the past decade, this video is going to spill all the tea from the history of the company to the truth about their strategies and where Open Door Capital is headed. You're going to hear it all here. Now, how would I know this level of depth about Open Door Capital? Simple. I founded it in the back of a van on a tiny Hawaiian island half a decade ago. I'm going to tell you that story in just a bit, but I want to start with the question that's probably brought you to the video. Is Open Door Capital legit? Should you invest in it? What kind of proof or evidence do we have that your money is best put there rather than someplace else? Of course, as the founder, I'm going to say, yeah, we're a great place for your money, but don't ever invest in a deal or a company just because the owner said so. Instead, it's important to dig in to 4 key pieces of information. And that is, number 1, the niche and strategy the company's in. Number 2, the experience of the team in their real estate businesses. Number 3, the track record of the company itself. And number 4, the incentive alignment that investors have with the owners. Now, that last one is super important, so be sure to stick around for that. But we're going to start with the exact niche and strategy of Open Door Capital. So we started by investing in mobile home parks. Now, individually, myself and my partners, we were in real estate for years before we started Open Door Capital, or ODC, as I'll probably call it going forward. And individually, we've done a ton of different investment strategies and niches. But when we came together to form Open Door Capital, we decided to focus initially on becoming the best mobile home park investment firm in America. I mean, for several years, that's all we did. Why? Because mobile home parks are powerful investments in that the expenses are widely paid by the tenant who usually owns their own home, and we just rent them the land. So this stabilization of expenses is really awesome for trying to predict future cash flow and growth. We also love that mobile home parks play into the affordable housing space because I always want to invest in things that are like solutions to major problems. And affordable housing is a major problem in America and honestly around the entire world. Now, after buying more than 50 mobile home parks, we branched into a similar niche, multifamily apartments, something individually all of the partners at Open Door Capital had done extensively. We bought multifamily properties in Texas, Georgia, Florida, and Colorado. We are big believers in the multifamily space, really for the same affordable housing issue reason. But we bought fewer of those apartments this year and last year just due to interest rates and competition. And honestly, we would rather not buy a deal than buy one that's mediocre. So that led us to another niche, self-storage, which has a phenomenal record of performance during recessions and has been working really, really well for us. I mean, my general philosophy when it comes to investing is not to get distracted by shiny object syndrome, of course, but you always have to have a pulse on the market and lean into what works after long, careful examination and testing. So in the future, we may add or remove niches, but we only do so carefully, methodically, and with the full unanimous agreement of our founders and executive team. So the second factor in deciding to invest in a syndication like Open Door Capital is the experience of the team, the members on the team leading it. In our case, I've been investing in deals since I was 20. I'm 38 now. So almost 20 years ago, I started. Brian Murray and Ryan Murdoch, my 2 co-founders, have been investing for about the same amount of time, with thousands of units bought between the group before we ever even got together. I'm also the author of 5 of the top 20 best-selling real estate books in America on Amazon, including the #1 best-selling book, the book on rental property investing. And Brian is also the author of several of those top 20 books, including the wildly popular Crushing It in Apartments and Commercial Real Estate. We even co-wrote 2 books on multifamily investing, The Multifamily Millionaire, Volumes 1 and Volumes 2. In addition, our 7-person executive team has combined decades of experience in real estate, multifamily, mobile home parks, business administration, and more. It is truly a stacked deck of experience, and that was very much by choice. That leads me to the third factor, the track record. So now, in nearly 20 years of investing in real estate, I've lost money on one deal. It was a small $50,000 purchase of a home that I did when I was 26. Of course, if I would have held on to that flip, I tried to flip the house. Terrible idea. If I would have held on to it, I'd be sitting on $500,000 of equity today. But hey, that's why I love buy and hold. The only time I lost money was trying to flip a house. And I don't flip houses or properties. I've learned that over the long haul, real estate is a really forgiving asset. Now, as for ODC's track record, our first fund to go full cycle, where we bought it, fixed it up, and then sold it, netted investors more than a 35% IRR, which, of course, we have to say, results aren't typical. Every deal is unique. But it is nice to look at that as evidence that even even on our very first deal when we were just getting started, that deal crushed it like it did. Now, we hold almost everything we buy for the long term. We're not flippers, long term. So we don't sell much, but over the past 5 years, we've distributed millions and millions of dollars in cash flow to our investors, which is just pure mailbox money. But I also said I would tell you the good and the bad when it comes to ODC. So I'm going to be honest. We got hit pretty good by insurance hikes on our Texas multifamily properties and a few other deals over the past year or two. Insurance went nuts. So we did stop distributing cash on a few of our funds in an effort to hold on to cash, knowing that a recession is likely on the way. Pausing distributions, you guys, is never fun. But our investors have stuck with us, understanding that it wasn't like a poor decision that we made by our team that led to us pausing those deals. It was the market and the dynamics largely outside our control. But because they're good assets in great areas, we don't expect any long-term problems with these properties. Again, we're in this for the long haul. We are long-term buy and hold investors. Now, on to the last evaluating factor, the alignment between investors and the company, or in technical terms, between the LPs, those who invest their cash, and the GPs, those who run the business. You see, when an investment firm like ours buys a deal, there's typically a fee, and it's anywhere from 1% to 3% of the property's sale price. Now, that fee goes to the company. It helps them pay salaries and just keep the lights on. But what some syndicators out there have done, and I don't want to trash out the syndicators, there's great people in this industry, but some people just take that fee and they buy mansions and jets and helicopters and just, they live on that fee. In other words, these syndicators have made massive profits even though the deal hasn't made any money for their investors yet. Now, I always thought that was ridiculous. It's just completely out of whack alignment. So when I founded Open Door Capital, I wanted to really align incentives. So I did two things. First, the acquisition fee that our company gets, it funds the salaries for our team, but I don't take it myself. Other than a small salary of $100K, I don't get that money. B, I donate that $100,000 salary away to charity. So I really don't make anything. And then lastly, I invest in every single deal Open Door Capital does. So not only am I a GP member, but I'm also an LP member. I make money as an LP as well. So now, if we deliver the kind of returns that we expect and that I project to, I'm going to make plenty on the back end. But that is only after you win first and win big. So how do I pay my bills? Easy. Remember those books I told you about earlier? I live mostly on book sales. I do speaking gigs, and I get cash flow as an LP. So we really have aligned our interests, which I think is the right way to do things, and one of the main reasons we've been able to raise $400 million. All right, this video is getting really long, but I want to end with the beginning, the founding of Open Door Capital. So I was in the back of my friend Ryan Murdoch's this white van. We were traveling to the beach on the island of Maui, where I had just moved. Ryan and I had both moved there, and we were hosting a mastermind meetup with other millionaire successful real estate investors. Now, we were using Ryan's van for transportation to the beach, and so we grabbed one of the members of that mastermind, a guy named Brian Murray, and we headed out for the drive to the beach. And it was on that van ride that the three of us were just chatting, and we all said how we wanted to get into larger commercial real estate deals, and we wanted to form a syndication. And then one of us, I don't remember who, was like, well, why don't we just do it together? And that was the beginning of Open Door Capital. Now, of course, we've come a long way. We got more than 100 employees over nearly 100 properties across 20 plus states. And today, the day-to-day operations of the company are run by Walker Meadows as the CEO and assisted by our incredible executive team. Now, Brian, Ryan, and I are still very actively involved. We call ourselves the board, and we work every day to drive the company forward. Now, finally, for those unaware of how a syndication company like Open Door Capital works, let me just lay out the basic framework so you can see how this model truly can be a win-win between GPs, LPs, and even tenants. So our team at Open Door Capital, we go out and we work tirelessly to find great deals. That involves building relationships with brokers, analyzing hundreds of properties, visiting properties, making offers, getting rejected, fighting for a deal, and then once in a while, we land something big and potentially very profitable. So for easy math, let's just say that we are going to buy a $10 million property. Now that property is going to need a large down payment. We like to put large down payments because it reduces risk. So we might put $4 million down, plus maybe another $1 million for repairs because we typically buy value add, stuff that we can improve. So now we go to investors, normal people like you, not Wall Street, but Main Street, and we raise that $5 million. As I said earlier, I invest in every single deal, but my books don't sell that well, so we rely on our LP connections for the rest of that money. Now a bank supplies the rest of the loan, and then we buy the property. So the bank provides roughly $5 million, our investors provide $5 million, and we buy the deal. Now, by the way, since our inception, we've raised over $400 million from over 2,300 investors, many who are repeat investors with us. So now we buy this property and we get to work fixing it up. We get it running at max efficiency. We make it a cash flow machine. And then we start distributing cash flow to our investors, sometimes all of it. We typically don't start taking a cut, like the GP, until investors have gotten a significant return on their investment. Now that is called the pref. It's short for preferred return. So once we hit that pref, like usually 7%, but that can change a little depending on the deal. After you get your 7%, then we split profits going forward. Usually 70-30, where investors get 70% of all the profits going forward and we get 30. But again, different deals, different details. So in some cases, investors can get up to 90% of the profit splits. And then someday, way down the road, we'll sell the property and hopefully make a killing. For example, that $10 million deal we bought, we improved it, we fixed it up, we made it better, rents went up. So let's say we sell it for $20 million someday. Now, all that profit, that $10 million profit plus, that gets split between the GP and LP based on how we defined it at the beginning. And the GP gets paid then, that's when I make my money, and the LPs, though, get the bulk of it. So it truly is a win-win, and that we, the Open Door Capital, are really good at finding deals and making them profitable. We're great at property management, great at tenants and toilets and trauma. So ideally, we earn our cut because we're more than 30% more effective than what you would do on your own. I mean, that's my goal. I want you to make more money with me than you would on your own, but with zero work needed. That's like a win-win. And even the tenants win because we're buying properties that can be improved and managed with dignity, effectiveness, and care. And so that's the good, bad, and ugly of Open Door Capital. Are we perfect? Of course not. I've made mistakes, and I'll make more. At the end of the day, though, we are good people doing good. We want to win together with integrity and over the long haul. We want long-term relationships, and we want people to invest over and over and over with us because we communicate really well, we solve problems intelligently, and we produce the kind of returns that your future wealth needs. That's how we grow your wealth. That's how we grow my wealth, and that's how we build a generational business that I hope someday my kids will want to be a part of and take over. I hope this video helps you learn a bit more about Open Door Capital. And if you're thinking about investing, just head over to odcfund.com. You can learn more about us there. For Open Door Capital, my name is Brandon Turner, signing off.